from the Mutual Broadcasting System. This is STRAT, Strategic Risk Assessment Talk. Now, retired Marine Intelligence Officer and globally recognized risk expert Hal Kempfer.
Welcome to STRAT, Strategic Risk Assessment Talk. And this week, unlike last week, I don't have a guest, although in a couple weeks I'm going to have another guest on. And I'll let you know more about that as we get closer. But I'm going to talk about something that's been in the news. And you're going to say, okay, you're kind of used to hearing me talk about wars, terrorism, all sorts of other things, which you normally think of as risk in a very kinetic sort of way. And I'm going to talk about something which maybe you could say this is war. There's been a lot of headlines, a lot of discussion of essentially tariff wars, if you will. Things going on with certainly Mexico, Canada from the U.S., and then, of course, also China. But also, certainly the Europeans aren't feeling a lot of love from the United States at this point either. And I'm going to talk about tariffs, and I'm going to talk a little bit about international trade. And a little bit of background. I happen to have a graduate degree, master's degree in international management, kind of like a global MBA, if you will, from a school called Thunderbird, which is in Arizona. It's a little alumni bragging here. It's the number one ranked international, or was the number one ranked international business graduate school in the country. So I have that. And also I've done a lot of work with U.S. Customs over the years, and a lot of work with a variety of government organizations. But with that, I've had a chance to look at a lot of bills of lading and you name it. A lot of different things where we go in and try and figure out what commerce is coming into the country. And of course, I was looking for smuggling, fraud, things like that. But it gives you a sense of what that is, and some specialized training at the Federal Law Enforcement Training Center. So anyway, the long way of saying that I've done a lot of that stuff, and I got an undergraduate degree in economics. And so I'm going to talk about tariffs. And it's not as, and the reason, look, if you're an economist and you're listening to me, you're probably going to say, that is not the most sophisticated, highbrow discussion I've ever heard on tariffs. I'm not talking like that. However, for most of us, it's not something we think a lot about. There's a certain allure of tariffs, obviously a political allure of tariffs, and we're not the only country in the world that has found tariffs to be a great thing. A lot of countries have done that. In fact, interestingly, there's so much attention on Mexico right now. Mexico has a long history of enormous barriers to trade while they protected their industries. And that's, if you want to go back to the 90s, that's what NAFTA was all about. The North American Free Trade Agreement with both Mexico and Canada was to tear down all these barriers to trade, because frankly, it was creating tremendous diseconomies, and it was preventing those economies to grow. India, despite the warmth that was shown with Modi in the White House by Trump, that India has historically always had huge barriers to international trade. Cars, for one thing, they protect their car market tremendously. You're not going to see U.S. cars, or a lot of U.S. cars in India. You're not going to see a lot of U.S. cars, period, overseas. And there's a reason for that. And it's not because the U.S. doesn't make great cars. And it's not because the U.S. makes the old 1970s, 1980s thing is the problem is the U.S. makes these big gas-guzzling cars and the global market doesn't want them. That's not the situation. There are a lot of other reasons why you don't see U.S. cars. So let me talk to you a little bit about tariffs. There's a reason why the U.S. and a number of nations around the world move towards free trade in the East and into the O's and beyond. There was a lot of compelling reasons, and part of it was to increase the economy, if you will, increase the availability at a more cost-effective level of goods and services around the world. There were some things that the U.S. did really well. For example, and this doesn't show up in gross domestic product, they're really one of the misnomers of GDP or certainly of trade per se is how do you measure services? Well, the U.S. is really good at financial services. That's something we've always been kind of a lead on. but that doesn't often show up in the numbers. So a lot of things that we do actually don't show up in the numbers, but there are certain things that were more labor intensive, hard production sort of manufacturing things that moved overseas, and those would show up in the numbers. So it tended to have and some would say an exaggerated effect, that if you took a company from Michigan and you moved it to China or you moved it to Mexico, then it would look, you would see those numbers just jump right out at you. And so we'll talk about that a little bit more. Simply put, with trading stuff back and forth, the idea is that you can get more products for the same, for a lower cost than if you tried to do everything yourself. Now, this gets into a lot of other issues. Debt financing to pay for some of this, and a number of countries have huge trade imbalances, and there's a phenomenal amount of debt that underlies a lot of these trade imbalances, and so that causes some real issues. But in simple terms, you go, okay, I'm looking at China. We got a big trade deficit with China. We got to correct that. It looks like a very linear equation, but it's actually a very global equation across the board. And as I mentioned, some things just don't show up quite the same. Now, the discussion of why global trade is good is a concept called comparative advantage. And it's been around for a long time, since the early 19th century. And it's an economic model. And it's the advantage of trade with others over trying to produce all the goods that you consume. A good can be produced at a lower relative, shall we say, opportunity cost, if you will. I think the term autarky cost, that probably means nothing to anybody. But basically, a lower relative marginal cost can be achieved by trading goods than trying to produce everything. It describes a simple economic reality of trade for individuals, firms, countries, if you will. And there's a lot of different factors that go into it, and a lot of issues on technological progress. If you go back to, for example, the early 19th century in England, they were this industrial powerhouse. And they had these vast factories and industries and everything that produced a lot of goods. Meanwhile, they had a British Empire, if you will, that had a lot of raw materials. It had agricultural materials. It had certainly mineral wealth, a lot of things that were needed for this industrial powerhouse. So getting minerals, trying to get those minerals from another country, in their case, it's colonies in that case, and sending it to Britain made a lot more sense than Britain trying to do that. I mean, the British love tea. Tea's a wonderful drink. It's a great beverage. But Britain doesn't really grow tea. Now they could have lots of greenhouses and bring the ambient temperature up where they could possibly grow tea. Although it makes more sense to try and get tea from places like Sri Lanka or India. And having spent time in Sri Lanka, having spent time in, tea plantations in Sri Lanka, let's just say it's a heck of a lot warmer, much better climate for growing tea in Sri Lanka than it is to try and grow tea in England. And hence it made more sense to trade whatever England produces for getting tea from Sri Lanka. That was one of those things. The guy who was kind of behind this whole concept was an economist, a classical theory, if you will, on comparative advantage. The guy's name was David Ricardo. All right. And he described this way back in 1817 to explain why countries engage in international trade, why it is an advantage. Even when one country's workers might be very efficient at producing a single good, and another country's workers are very efficient producing another good, he would take all that together and say, look, they do better at making this, we do better at making that. Rather than us trying to make everything, let's just trade and we get more stuff. I'll give you a kind of an odd example that I've often heard is if you're from a northern country, for example, if you're in Washington State, you grow apples. They got a lot of apples up there. All right. If you go down to Central America, they grow bananas. They don't grow apples in Central America. I mean, it's theoretically possible, again, in a greenhouse environment or something like that. Theoretically, they could grow apples, okay? And the same thing's true in Washington State. If you were to set up a bunch of expensive greenhouses, theoretically, you could grow bananas up in Washington State. I'm sure somebody up in Washington State is growing bananas in a greenhouse. I have no doubt. But but that's a lot of resources. That's a much higher cost to grow bananas in Washington State. And the same thing's true of apples down in Central America. So the smart thing to do would be to trade apples that can be produced at a lower cost in Washington State for bananas in Central America, which again can be produced at a far lower cost in Central America, and then bring those up to Washington State. That's an example of comparative advantage. And for the consumer, they can buy more total apples and more total bananas across the board rather than spending big Washington State, someone in Seattle spending big bucks for bananas that were produced somewhere in the Seattle, Tacoma greater area. And certainly for someone down in, say, San Salvador trying to purchase apples that were being grown at some facility down there, they can get a lot more of both. So that's the advantage of that. Now, with that said, when he kind of came up with this theory, there wasn't the global finance system that we have today, and labor couldn't move easily between borders. So in his thinking on this, labor was kind of a static thing that would stay in one place, stay in one country or one location, and capital, finance, money wouldn't move as fluidly as possible either. So it had some limitations in terms of that, but that's the basic concept of comparative advantage. All right. So with that said, every nation in the world has politics. You just can't get away from it. Every country has a certain degree of politics, and with those politics, there are interests, special interests or interests within those countries. All right. I don't know of any country in the world that doesn't have a certain affinity towards the farmers. Farmers grow stuff from the earth. Farmers are kind of the, if you will, bread and butter, so to speak, of every country. All right. And there is always a political pull, a tug, if you will, to protect farmers. In many cases, well beyond the numbers of farmers. I think in the United States, those totally dedicated to agriculture, as I recall, is about 4% of the population is tied up with agriculture. Amount of the population is tied up with stuff that has nothing to do. And it might be lower than 4%. It might be closer to 2% now. But that's because a lot of agriculture is automated. And by the way, a lot of those farms, as much as, you hear politics of we love the family farm, most of those family farms are no longer family farms. They're corporate farms that actually produce agricultural products with greater economies of scale. And that's just a simple economics of that. But farmers have always been near and dear to folks' hearts. And also within that system, if you look at, for example, it shows up in our political dynamic. You have states with far lower populations that have huge agricultural bases. Iowa is a very agricultural state. All right, Indiana is even though Indiana has a lot of other things, it is a very agricultural state. And so there's a lot of states that have a tremendous amount of agriculture. Yet, for example, if you go to the U.S. Senate, Iowa gets 2 U.S. senators. California gets 2 U.S. senators. So even though these states have vastly different economies, California has a vastly larger economy than, say, Iowa, has a much larger population than Iowa. In the political spectrum, that doesn't always reflect itself perfectly. And it's things like that don't reflect perfectly that make for some of these disconnects, if you will. All right. Now, there are trading blocks. For example, in Europe, they wanted to build up the European economy. The U.S. was all for this. We actually supported the European Common Market, which became the European Union. We wanted to see the European economy integrate. We wanted to see the European economy grow. And so we pushed for this. And so they lowered barriers to trade within Europe. However, outside the European Union, there were barriers, as they were protecting a lot of industries and stuff within Europe. And whereas we were very supportive of what they were trying to do, it was hurting us on the political sense. One of the industries, for example, in Europe they wanted to protect was the automobile industry. We have a very large automobile industry, but it was very difficult to export cars to Europe. In fact, what we were kind of compelled to do, our automakers do, like Ford, would put car plants in Europe, produce the cars in Europe because it was simply that was how you got cars into Europe. So Ford has a big footprint in Europe, and that was one of the things with the European Union. All right. The challenge with international trade is actually it's much more complex than just a tariff applied to a product being imported or exported or being imported into a country. The countries will do all sorts of things to incentivize various different things. They will have tax breaks for certain industries. They will have grants or low interest or subsidized loans to certain industries. The U.S. does not have universal health care, so to speak. We don't have a national health service in the U.S., for example, like Great Britain does, or for example, like Canada does. A lot of countries in the world have this national health service. We don't have that in the U.S. So healthcare costs for a company in the U.S. with a lot of labor is normally borne by that company. That healthcare cost for the labor force within that company becomes a function of cost of goods sold at the other end. Now, if you go to other countries, they don't have that because the company itself doesn't pay for labor cost the company itself doesn't pay for the health costs of its labor force. In the U.S., it does. That will reflect that U.S. goods often will have a higher cost of goods sold because of the way we do healthcare. Now, that sounds very remote, and it's like, well, wait a minute. That shouldn't really make a big difference. When it gets down to what the cost of goods sold are, though, it makes a big difference. These are all things that are imposed in there, and then, of course, all the tax things and all the incentives that go into various industries. And, for example, and we do this here in the U.S., training labor for a particular industrial purpose. For example, I was consulting on building a mineral. It was basically a plant that was going to refine lithium. Okay. And one of the things that as part of this discussion was how do we train a labor force to work in our plant? And we were talking to that state. We're talking to basically a community college district in that state. And they go, hey, no, it's great. You build a plant here, we will set up courses at our community college to train your labor force into how to do this stuff. And that was going to be at no cost to us to have them do that. And that's a heck of an incentive. I mean, basically the training dollars for producing highly skilled labor for our particular industrial purpose was being completely subsidized by that state. All right, that's an example of something that will impact the cost of goods sold that come out of that plant. So there's a lot of things that really do go into it. Cheap labor is always a major driver, if you will, in locating manufacturing. And so if you look at certain countries, for example, China had cheap labor forever. That was the thing that China had, was cheap labor. Now, one of the things that China is running into now is as they have a bigger economy, as they have developed their economy, they don't have as cheap a labor. The other thing, too, is they did some things within China which were rather draconian. For example, in a lot of these cities where these industries are based, they would have limitations on who had permanent resident status in those cities. So they would have this very strange system where you'd have the labor force who were often moms and dads. Well, their kids were actually being raised by the grandparents somewhere in a rural area while they worked and earned an income in the city. It created some very strange familial issues with the country. And of course, because of this, and what China has a one-child policy for a long time, they had a decreasing labor pool. So they have a demographic issue where the labor pool is actually shrinking. And yet they have an economy that in large part was built on the idea of a vast wealth of cheap labor. And so they're running into this problem where they don't have a vast wealth of cheap labor. So the question is, where is China going to go in the future? Mexico has a lot of relatively lower cost labor. Of course, as things get more developed in Mexico, the cost of labor is starting to get more expensive. But we see that. And you see capital will move around the world and will locate manufacturing that's labor intensive in those places where labor tends to be less expensive. Of course, part of that too is the security environment. You can go to a country where it's very low cost of labor, but your investment is endangered constantly by civil war, civil unrest, government deciding to nationalize your industry. So there's a lot of things in there that kind of fall out of the purest economic thing, which gets into risk management. And that's one of the challenges. And as the U.S. is now pulling back under the Trump administration, pulling back from our overseas commitments, well, that also pulls back our ability to guarantee the security of our overseas commitments. That's part of what the issue with Ukraine. The U.S. wants to take a big position in mineral wealth out of Ukraine. Ukraine says, well, we got to have security guarantees. The reality is you can't open up a mine or start mining operations or underwater drilling operations or anything in that area. And you're not going to get investors to invest in that if they don't feel that their investment is secure. So at some point, security has to be in place. There has to be some guarantee of security. And whereas for political purposes, the Trump administration is saying, oh, we're not going to guarantee security, you're not going to do this. The reality is, if you're taking an investment, you're taking a position in an investment, and you haven't set the conditions where that investment can actually produce any amount of wealth that will come back to you. A lot of times this is missed, all right? It doesn't make for a nice, neat political statement, but that's a simple reality of what's going on out there. We talked about these various incentives that are out there, and that's one of the challenges that the European Union has, okay? The European Union has this very complex system where they look at all these non-tariff incentives, tax breaks, everything else. They look at all these things, and then they, through this vast Byzantine bureaucracy in Brussels, they come up with this stuff. This is actually what got Britain so irritated with the European Union. There is a feeling that it's very slow, very lethargic, and they also felt that it was favoring certain countries. They felt that the bureaucracy in Brussels would favor certain countries over other countries, and they didn't feel that they were getting their due consideration, if you will, for Great Britain. Plus, Great Britain has always been this vast seagoing power around the world. They have a huge amount of trade all around the world, not just with the European Union, and they felt that the European Union, which was more of a continental-based thing, was impacting them disproportionately in a negative way. Ironically, Ireland is also a European Union, or is now, UK is not, a European Union member. Ireland loves the European Union. They think it's fantastic and has worked out extremely well for them. And then even within Great Britain, places like Northern Ireland, Scotland, they also were big fans of the European Union. They did not want to break free of the European Union. They wanted to stay integrated in it. So a lot of disparate things, but the feeling was that all these ways that they were measuring, in many ways non-tariff incentives and discounts and everything, and trying to factor that into how they enable trade between the nations, that Britain felt that was not fair. The other thing they didn't like, which was part of the EU, also part of what's called Schengen, which is a European-wide thing where you plop into one country and you go through immigration in one country, and then you can move freely from that country to all the other Schengen member countries. So, for example, when I fly into Europe, I will clear immigration in Germany, and then I get on a plane, I fly down to Greece, and I don't have to clear immigration in Greece because I've already cleared it in Germany. Go figure that. So, and the same thing if I fly through Munich or fly through whatever, and I go to the Baltic countries, same thing. I don't have to clear immigration more than once. So, with that said, they were really upset about the free flow of labor throughout Europe, and the feeling was that labor willing to work a lower cost was coming into Britain, and then that was displacing Britons who wanted to work there. So they didn't like it, and Brexit, they basically, largely England, as I mentioned, those other locations, Northern Ireland, Scotland, they wanted to stay in the European Union. Britain or England did not, and they voted to break away. And there was a lot of promises that Britain could put up tariffs and they would make a lot of money from tariffs, and by focusing on trade elsewhere, that they were suddenly going to grow their economy tremendously. And right now, the feeling in Great Britain is that those promises really didn't come through. And tariffs was not this panacea. It didn't turn into this vast wealth of income for the British economy or for the British government. And so, they didn't like it. They are, generally speaking, they're not as thrilled with it as they were. And it's very possible they might try to reverse it at some point. But right now, there's not enough political impetus to do that. But Britain's economy their gross domestic product is about 64% tied to trade. The U.S. is different. We have a much more insular economy. Ours is only about 24% tied to trade. So there is a big difference there. And it's worth mentioning that I think maybe the very first act by the new U.S. Congress was to set up a trade schedule or tariff schedule so that the government could be paid for tariffs. And literally, the U.S. government subsisted off of tariffs for many decades before there ever was anything like a federal income tax. For one time, I think they would have said for most of its history. I don't know, it might be about even numbers now, but we didn't have a federal income tax for a very, very long time. So it was tariffs was how we made money. So there is truth that if you charge for goods coming in, but how do you apportion the cost of goods sold? I remember looking at shoes being imported from China back in the mid 1990s, and these shoes were shoes that would, if you went to a store, you would see them selling for like somewhere between $70 to $90 a pair. When they were being imported into the U.S., these shoes were literally running between $1 to $3 per pair in terms of what they were being valued at. So needless to say, there was a little bit of a markup on those shoes. But the question is, were we really seeing an accurate number applied to the cost of those goods sold? And by the way, so they sell them here, and it goes to some sort of importer here. They pay they're paying a tariff. They got this really low cost or valuation of those shoes coming in, right? And they pay that tariff. But they're going to turn around and sell those shoes for, 10 times more to some retail outfit that then's going to, put another markup on it. They're going to make a lot of money. Now, what stops them from sending money back to China to reimburse them for the cost of those shoes? In other words, the financial flow goes that direction and actually reimburses the Chinese company. And it could be done through a number of shell companies, could be done through third countries, a lot of different ways. That's where it gets into be somewhat complex. The ability to undercut and defeat tariffs they're a little complex, and I got to tell you this, it doesn't resonate well. If you're on the podium on a campaign trail and you're trying to get quick one-liners out there, it gets a little bit complicated, but the reality is that countries do this. If you get into international, that is pretty much the foundation, is trying to figure out how to move stuff around the world, how to realize profits with your corporation, how to do a lot of things and keep the cost in terms of taxation, whether that's a tariff or income tax or whatever, keep the cost as low as possible so you keep the most amount of profit, the most amount of money for yourselves and not spend it all, to a high tax country. That's why for a long time, Scandinavian countries have always had very high taxes because they had a lot of high social services. Well, international corporations would certainly try to avoid realizing their profits in Scandinavia and Scandinavian countries because they realized the tax was so high. All right. And there is some truth that maybe there is no such thing as corporate taxes because it just gets passed right on to the consumer. But the reality is, in a global trade environment where you have companies all over the world and subsidiaries and everything else, look, people are going to move around stuff in such a way that they don't have to pay more tax than they absolutely have to. And that's just the simple way that this stuff works. So it's a long way of saying, all right, there is a lot to tariffs. There's a lot of risk in going into this high tariff thing that we're doing right now. With that, there's a reason, it is true. If you get into looking at, for example, dairy products out of Canada, we're talking about putting a 250% tariff on that. Well, if you look at what Canada does internally in propping up its dairy industry, because it is it's It's a heartstring sort of thing. It's very important, to support the dairy farmers. I think the valuation I saw was that by the time it was all said and done, I think their equivalent was about 249% or something like that. So that's where stuff like that comes from. And you're going to see that certainly with cars. Why don't you see U.S. cars driving around Europe? You can give me all the excuses in the world, but the reason why is because there's barriers to selling U.S. cars over there. Meanwhile, I see no shortage of Beamers, BMWs, Mercedes, Fiats, whatever you got coming out of Europe. I see no shortage of those cars being sold here in the U.S. They would probably argue that's because we produce great cars. But the reality is it has more to do with trade imbalances and some of the barriers to selling our goods overseas. So that's being addressed. And we have this massive trade deficit with just about every place that we look. And so that's going to be one of those things that's addressed, but it does go to risk. But with that risk, with the U.S. pulling back on a security side, that's going to increase the risk for U.S. companies doing business overseas. And that's going to have to be weighed in too. All right. I hope that wasn't too much. If you want to hear more, you can go to Hal Kempfer TV on YouTube and listen to my frequent broadcasts. And I hope I just didn't get too much into the weeds on the whole tariff and international trade incentivization and taxation and all that stuff. But I just felt that needed to be said because I'm hearing this very simplistic thing thrown out on tariffs, and it's not simplistic. It's a very complex thing in terms of how these valuations are determined and what these tariffs will do or won't do. They have the potential of causing some massive disruptions in the market, and markets do not like uncertainty. They do not like sudden change, and the more we see, the more we're going to see the markets react. Anyway, thanks, and I hope you listen to the next Strat. I'll probably get back to other stuff like wars, terrorism, civil unrest, civil war, whatever. But I just felt the need to talk about tariffs this week. Thanks.